Okay, hi there. Welcome to this video where we're going to spend a few minutes looking at the economics of the supply crunch, which seems to be affecting many countries and especially the UK. So we hope that this video will give you some good examples for your application, which of course is part of the process of building good analysis and evaluation. So the supply chain crisis, or the supply crunch, has become real for many people in different ways. From my favourite restaurant being unable to open for a short while because of a shortage of chicken, to supermarkets now using cardboard cutouts of fruit and vegetables and other groceries to fill gaps on the shelves because of supply problems, and of course long queues for petrol during the what proved to be fortunately temporary panic buying of late September in 2021. So what do we mean by a supply crunch? Well, I would describe it as a series of factors causing a fall in market supply of perhaps key components, key raw materials, perhaps even key finished, completed manufactured goods at a time when demand is going up. So the result is that there's a shortage of products because of the supply chain difficulties. That leads to higher costs and therefore an increase in cost push inflationary pressure. And we'll model cost push inflation in an analysis diagram in a few minutes. So what are some of the key causes of the supply crunch affecting the UK at the moment? Well, partly it comes from the shortage of key inputs into production, and in particular semiconductor chips. It's become very difficult to buy a PS5 games console or smartphones, feeling the pinch as well. The shortage of component parts, semiconductor chips, is affecting everything from games consoles to even electric toothbrushes, and that's a major factor. Another issue is the fall in the supply of natural gas in the markets. Britain's a net importer of natural gas, and the Russian government has limited natural gas exports to the European continent at a time of increasing demand. I'm told that in Europe the price spike in natural gas, which I'll show you in a second, is equivalent in its effect as if oil was trading at about $200 per barrel. At the moment it's trading at about $80. And you can see here the surge in the price of natural gas, particularly in Europe. The United States is less affected. But in the UK, for example, gas accounts for 40% of UK energy generation. Nearly 4 homes in 5 are heated with gas, and over 22 million British households are connected to the gas grid. So this increase in prices is affecting households and businesses alike. Another aspect of the supply crunch is the shortage of HGV, heavy goods vehicle drivers. In many countries, and including the UK, latest estimates are that there is a shortage of more than 100,000 qualified drivers in the UK. That's partly the backlog of HGV tests due to COVID, but also a shift of workers away from HGV, perhaps towards working with smaller vans for delivery companies such as Amazon and other businesses. And there's also a hint that relatively poor pay and working conditions have contributed to the exodus. But clearly the UK is suffering from this shortage of drivers. We're also seeing logjams, hold-ups at ports and warehouses. So many containers are not getting unloaded from the vast container ships. And that, of course, is making containers in limited supply in terms of spare capacity. And it's also causing a big increase in shipping costs. So shipping rates, the cost of hiring a container vessel, for example, are soaring at the moment. And many shipping companies tend to favour the bigger, larger customers whose contracts are worth more. One way of measuring the cost of shipping in the world economy is something called the Baltic Dry Index. And this tracks the shipping rates for the 3 largest classes of ships. And you can see what's happened. And the index has actually jumped up in the last year and a half or so. The cost of shipping goods from Asia to Northern Europe, for example, has increased by 570%. And it's costing more than $40,000 a day to hire one of these vessels. Another aspect of the supply crunch are shortages of key materials, key components. Magnesium, cardboard used in packaging, lithium used in lithium-ion batteries. So a big rise in the cost of that. And also there's labour shortages. Some evidence, we're yet to get the full figures, that there has been a major exodus of workers from the UK back towards countries inside the European Union. Of course, the UK left the EU in January 2021. Something like between 1 and 1.5 million EU workers now left the UK since the start of the pandemic. And if you take the food industry, for example, the food supply chain, there were apparently a few weeks ago over 500,000 staff shortages, which is about 1 worker in 8 in the industry. That industry has relied heavily, so too is farming and construction, from workers coming from the EU. So overall, the supply chain crisis is having both a micro effect, that means affecting specific industries and markets, but also a wider macroeconomic impact. Some claiming these supply chain shortages are the worst for nearly 40 or 50 years. And here's another aspect of the supply crunch which might be important in the weeks and months ahead. Available warehouse space in the UK has fallen now below 50 million square feet. It's the lowest level since well before the global financial crisis 10-12 years ago. So here's another aspect of the supply crisis which could well gather momentum in the weeks and months ahead. Some of these causes are short-term, some of them are in a sense temporary, but others could be longer term. And I think this distinction between short-term and long-term causes is a really good way of evaluating the macro effect of the supply crunch. So how will the supply crunch affect some of the key macroeconomic objectives for the UK? To what extent is this issue going to hold back the recovery from the pandemic? Well, I guess the most obvious point to make is that it's likely to, and is probably already leading to, an increase in inflation. You see, the supply crunch is causing high input costs for businesses, higher raw material component and energy costs, for example, and many businesses are having to make tough key decisions about whether to pass on some or all of this cost to their consumers in form of higher prices. And we can see that the consumer price index here, the CPI rate of inflation, is already above 3%, well above the target rate. The Bank of England predicted it would be above 4% this autumn. The chief economist of the Bank of England thinks inflation in the UK could rise as high as 5%. Second macro effect is investment. If businesses are facing higher costs, that means they will have to, they'll take a hit. The profits will take a bit of a hit, and their confidence will probably suffer as a result. And if profits are down and confidence is lower, that might well hit capital investment spending. So investment might take a negative direction. And quite a few UK business leaders are warning that this supply crisis could last at least until 2023, well into the year after next. A third consequence could be for consumer spending. You see, if prices are going up by, let's say, 3, 4, 5%, but wages aren't rising as fast, then for people in work, their real incomes will fall, which might cause a reduction in consumer spending, of course the biggest single component of aggregate demand. The trade balance will be affected. The UK, I've already mentioned, is a net importer of gas. We also import minerals and metals and semi-manufactured goods and other component parts. So if the cost of imports goes up, especially if demand is price inelastic, that's going to worsen the trade balance. And also economic growth. If you take these factors together, weaker investment, falling consumer spending, a worsening trade balance, you would think that this supply crunch is going to slow down the growth rate of the economy as it tries to recover from the pandemic. Well, how can we model the effects of a supply crunch using an aggregate supply and demand diagram? Don't worry if you haven't covered this yet in your year 1 or year 12 economics, but here's a simple way of modelling it. Here's our short run aggregate supply against demand. So the initial equilibrium is at general price level 1 and national income level Y1. While higher costs cause an inward shift of supply, so we move to SRAS2, and that causes the price level to go up and the real national output to go down. And the higher price level causes a contraction up the demand curve, in part because real incomes will have fallen. So this is one way of using a diagram to illustrate what might be happening at a macroeconomic level: slower growth, higher inflation from the supply crunch. And this is linked to fears of stagflation in the UK. So what's the UK government doing to address the supply crunch issue? Well, the initial policy changes have been fairly modest, perhaps not necessarily sufficient. They've introduced a 3-month visa scheme to cover truck drivers from the EU and trying to encourage people to come and work in the meat sector. This truck drivers scheme, I think, finishes on Christmas Eve, so it's unlikely to have much of an effect. But hauliers and poultry workers are going to get temporary visas. Whether or not this is going to work, of course, is open to question. You could always talk about here the risk of government failure. Well, other things the government's done, they've provided some temporary subsidies, emergency loans to the fertiliser plants, which were being hit hard by an increase in the price of natural gas. And CO2, of course, is a byproduct from the production of fertiliser, used in lots of industries, including supermarket foods. So the government's providing some emergency funding. They've extended the limit on how long drivers may be at the wheel, and they've shortened the process to qualify as an HGV driver. And again, think about the possible government failure here if they fast forward or play fast and loose with the HGV testing system. What does that do to the quality of drivers on the road, for example? In the medium term, the government thinks that businesses will adjust and have to adjust to this supply crisis. So they want corporations, large and small, to respond to these challenges by raising wages, by providing better training, and fundamentally lifting labour productivity. But of course, these things can take months and years to come to fruition. Just recently, in fact today at the time of recording, the government's just announced that they're going to increase the national living wage, which is really the minimum wage for adult workers aged over 22, from about £8.90 per hour to £9.50 an hour from April 2022. Now that's a 6% increase in the living wage, and in theory should attract more workers into relatively low paid jobs. But again, the issue is whether that's going to add even more cost to businesses at a time when other supply costs are going up. But there's the news: the national living wage is set to rise to £9.50 an hour. I think the crucial point here is to think about some of the longer term causes of the supply crunch. And here are three that really aren't changed by a minimum wage, really, or by temporary changes to the visa system for hauliers and for poultry workers. I mean, fundamentally, the UK has an ageing workforce. If we look at the lorry drivers in particular, the average age of an HGV driver is 55. Only 1% of drivers are under the age of 25, and less than 1% are female. So there are some quite clearly long-term structural issues that will need to have to be addressed here if we're going to overcome this supply crisis. And in many industries for the last 10, 15 years, HGV driving, working in pretty dangerous and pretty soul-destroying food processing factories, the relative income of these people has been falling, and working conditions in many cases have been poor. And people respond to incentives, and many thousands of people have left these industries to perhaps find alternative jobs. Many part-time workers, for example, in the gig economy, HGV drivers deciding to drive delivery vans instead of lorries for a living, with some of the fast-growing businesses like Amazon. And Brexit cannot be ignored here. So we have left the European Union. We have a trade deal with the EU, which means we can trade tariff-free with the EU. But there are extensive non-tariff trade barriers now between the UK and the EU. In particular, much more rigorous customs checks, regulatory checks on things like food imports and things. So the cost and the complexity, as well as the inconvenience, if you like, of cross-border trade has gone up. And that is a factor affecting supply costs. It's a friction, a trade friction, which is increasing the cost of supply. And I guess the other point I would make is that the supply crunch, I think if you're doing theme 4 economics, is a really good example of one of the downsides of globalization. That we have global corporations that are heavily reliant on long supply chains from around the world, textiles from Bangladesh, semiconductor chips from China, natural gas from Russia, component parts from Poland. They have these very efficient just-in-time supply chains, but yet the supply disruptions we've seen in the world economy highlight just how fragile some of those supply chains are. They're hyper-efficient, but they're not necessarily very resilient. And that is something that businesses are definitely going to have to address in the months and the years to come. So the supply crunch, I think, is a really interesting current topic. It has both a micro and a macroeconomic dimension, so therefore it's a good synoptic issue to look at. Thank you for joining this video. Take care and see you all again sometime soon.